Germany's Bundesbank is just one institution to offer a warning that high energy prices could tip the country, and potentially the European Union, into recession. Meanwhile, European Central Bank President Christine Lagarde seems more frightened about the risk of a downturn than she does inflation, judging by how slowly the monetary authority is moving to tighten policy. 117 global interest rate increases so far in 2022, not one from the ECB. In the coming week, we'll get fresh insight from two useful indicators regarding Europe's economy, and perhaps whether we're seeing inflation, deflation or stagflation, and an upturn or a slowdown. One is Germany's IFO, the other Belgium's Courbe Synthétique. The former is valuable because Germany is the EU's largest economy. The Courbe is handy because it seems to be an uncanny guide to the benchmark Euro Stoxx 600 equity index. The latest reading for the National Bank of Belgium's Courbe is due on Monday the 23rd of May and the IFO on Wednesday the 25th. In April, the Courbe Synthétique rose to 2.4 from 0.4. Now that still left the indicator 2 points lower than a year ago and also 7.7 points below its July high. Services industries were less optimistic, presumably due to input cost inflation, but building, manufacturing and trade industries were a little bit more positive than they'd been in the previous month. In April, the German IFO Business Climate Index finally stabilised as it eked out a 1 point gain to 91.8 to pull away from March's 14-month low. However, the Business Expectation Survey came in at just 86.7. That did represent a minor month-on-month gain, but the 5.1% gap between current climate and expectations suggested that German businesses were preparing for tougher times ahead. On the corporate front, there's a long list of annual general meetings, with a decent list of results and trading updates due along the way from large, mid and small cap companies alike. Names which may be worthy of further research include the following, although do note that some of these dates could yet be subject to change. Kingfisher and Bloomsbury Publishing on Monday the 23rd of May. JD Sports Fashion, RS Group, Electro-Components as was. Shaftesbury, Hill & Smith, Cranswick and Speedy Hire on the 24th. SSE, Intertech, Pets at Home, Marks & Spencer and Hollywood Bowl on the 25th. Auto Trader, United Utilities, Johnson Matthey, Wix and S&U on the 26th. And Renewy and Treat on Friday the 27th of May. But the company which could just cause the biggest fuss in the week ahead might be Severn Trent. The utility, which provides water and water treatment services to around 8 million people and 4.5 million households across the Midlands of England, is scheduled to release its full-year results on Wednesday, the 25th of May. Now, shares in the FTSE 100 firm have done pretty decently in the past year, rising by a quarter, and they set a new all-time high just earlier this month. By contrast, the FTSE 100 is up by 6% over the past 12 months. Now, there are a number of possible reasons for Severn Trent's solid showing. First, utilities can offer inflation protection as their revenues and dividends often come with some degree of an index-linked angle. Secondly, the shares offer a respectable dividend yield of around 3.3%. And finally, the company looks to be off to a good start in the AMP7 regulatory cycle that runs from 2020 to 2025. February's full-year trading update revealed that Severn Trent was on track to earn at least £75 million in outcome delivery incentives, or ODIs, for beating key regulatory targets. Analysts will be looking to Chief Executive Liv Garfield for more detail on all of those headlines, and also on how the full-year results compare to the company's guidance given alongside the annual results of a year ago and then updated alongside November's first half figures. The key points then were a forecast of an increase in sales of 6 to 7% to £1.7 billion. High operating costs were expected, even as COVID-related bad debts fell, thanks to an upward cost pressures from energy and chemicals, with higher property sales and strong ODR results contributing positively. Analysts will also keep an eye on whether any customers are struggling with their bills, thanks to the surge in the cost of living and what assistance Severn Trent might be able to offer. That combination underpins analysts' forecasts of an 8% increase in adjusted pre-tax profit for the fiscal year to £510 million against last year's £473 million. Severn Trent then expects to have an adjusted effective current tax rate of basically zero, down from 11.4% last year. This is thanks to the capital investment super deduction tax break introduced in the 2021 budget, which will run until the end of March 2023. That should help net profit and therefore earnings per share calculations. A further big number to note is capital expenditure. This peaked above £800 million as Severn Trent got ready for the end of the AMP6 regulatory cycle, and it's forecast to come in between £550 and £650 million in the year just finished, including 6 green recovery projects. Severn Trent may choose to front-load the AMP7 capex plans to make the most of the super deduction tax break, and analysts are looking for spending to exceed £750 million in the new fiscal year. Capex can help to boost cash flow if it's reined in, and it's cash flow that funds the dividend, always a key point for any utility. And investors do tend to look to them for juicy dividend yields because in the end, let's face it, they're not always growing very much. Under AMP6, Severn Trent's policy was to increase the dividend by the retail price index inflation benchmark plus 4 percentage points. Under AMP7, the goal's a bit less ambitious, to raise the dividend in line with CPIH inflation. Now, at the start of the fiscal year in April 2021, that was 1.6%. It's now running, though, at 6.2%. Management has guided to a full-year dividend of 102.14p a share against 101.5p a share last year. Now, that CPIH figure will make any dividend guidance for the year to March 2023 particularly interesting. And analysts and shareholders will also look to any other forecasts from Liv Garfield and her team on the board. As they stand, the consensus forecasts are as follows: a 5% increase in sales to just over £2 billion, an 11% advance in adjusted pre-tax profit to £566 million, and a 5% hike in the dividend to around 107 pence per share. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.